Imagine for a moment the gears of the global financial system quietly humming along. The overnight exchange of collateral, the invisible flow of cash between institutions, the subtle balancing act of lenders and borrowers. Now imagine one morning those gears suddenly grinding to a halt and interest rates shooting up from around 2% to over 10% within hours. What if I told you that this happened not during the 2008 crash, but in September 2019, and that even now, most people don't fully understand why? Welcome to the story of the Repo Panic of 2019, a brief but dramatic liquidity crisis that shook the hidden plumbing of modern finance. You might assume that financial crises only happen when banks collapse or bubbles burst. But what if panic can arise not from insolvency, but from a simple shortage of cash? In September 2019, the market that underpins trillions of dollars in daily lending froze almost overnight. The event was short-lived, yet it revealed just how fragile the supposedly safe machinery of modern money had become. The question isn't only what happened, but why no one saw it coming, and whether it could happen again. To understand this, we need to step back and look at the repo market, short for repurchase agreements. A repo is a short-term loan. One party sells a treasury bond and agrees to buy it back later, usually the next day. The borrower gets cash, the lender gets the bond as collateral. It's the way large institutions like banks and hedge funds handle their daily liquidity needs. Without repos, the smooth functioning of bond markets and even corporate finance would be impossible. This market might sound obscure, but it's gigantic. Every day, trillions of dollars move through repo transactions. It's the bloodstream of modern finance, invisible to most people, yet vital to everything from pension funds to mortgage rates. If something goes wrong there, the effects spread quickly across the economy. In 2019, that bloodstream suddenly clogged. After the 2008 financial crisis, the Federal Reserve flooded the banking system with reserves, basically piles of extra cash sitting on banks' balance sheets. This created a cushion against liquidity shocks. But by 2017, the Fed began shrinking its balance sheet to normalize policy. That meant those reserves started to decline. By mid-2019, the total reserves had fallen to the lowest levels since 2012. The system still looked fine on paper, but the margin for error was thinner than anyone realized.
Meanwhile, the U.S. Treasury was issuing more and more debt to fund government deficits. Banks and dealers bought those treasuries and financed them through repos. So even as cash reserves fell, the need to borrow cash against those growing piles of treasuries increased. The strain was invisible, but growing. The system was quietly being pulled in two directions: less liquidity or collateral. The repo market isn't one big pool where everyone trades freely. It's divided into segments. Some cleared through big custodians, others through clearinghouses, others done directly between institutions. This segmentation matters because when stress hits, cash doesn't always flow to where it's needed most. A money market fund might be flush with liquidity, but regulatory limits can stop it from lending to a particular dealer. So even though the system as a whole had enough cash, it wasn't accessible to everyone. By late summer 2019, conditions were already fragile. Then, in mid-September, two seemingly routine calendar events collided. Corporations had to make large quarterly tax payments to the U.S. Treasury, sucking cash out of the banking system. At the same time, the Treasury settled a massive new issuance of bonds, tens of billions of dollars worth, meaning buyers had to pay cash for those securities. Those two events drained over $100 billion from bank reserves almost overnight. This was the spark that set off the panic. On the morning of September 17, 2019, the repo market simply seized up. The cost of borrowing cash against treasuries skyrocketed. Overnight rates, which normally hovered around 2%, exploded to 5, 8, even 10% in some trades. For context, that's like your mortgage rate quadrupling in a single day. No one had seen anything like it since before the financial crisis. The most unsettling part was that nothing big had broken. No bank had failed, no default had occurred. It was just that cash had disappeared from the system temporarily, and no one wanted to lend. The overnight lending machine, the core of short-term funding, had jammed. Some firms were forced to pay whatever it took just to get the cash they needed to meet obligations by morning.
At first, traders were baffled. Theories flew across the market. Had a major fund pulled out? Was there an operational glitch? Soon it became clear. The problem wasn't a mystery actor. It was the system itself. Banks had less flexibility to lend their reserves because of internal liquidity requirements. Money funds were cautious. Collateral was abundant, but cash was trapped. The repo market had become a bottleneck. By mid-morning on September 17th, the Federal Reserve stepped in. The New York Fed announced an emergency operation, offering to lend up to $75 billion in cash overnight to anyone with eligible collateral, mainly treasuries and agency bonds. Within hours, over $50 billion was taken up. The next day, they offered more. The panic subsided almost immediately. The machine sputtered, then resumed its rhythm. The immediate crisis was over, but the questions had just begun. How could such a small, predictable event, tax payments and treasury settlements, trigger such a violent reaction? If reserves were supposedly ample, why did the market behave as though cash had vanished? The answers pointed to a deeper truth. Liquidity isn't just about how much cash exists, but how easily it can move. The event also exposed something else. Over the years, the Fed had assumed that banks would lend out excess reserves when rates rose, but in practice, many banks hoarded their liquidity rather than lend it out in the repo market. They were constrained by regulations designed after 2008 to make them safer. Ironically, those same safeguards made them less flexible during stress. The plumbing of finance had become more rigid, not more resilient. For months afterward, the Fed continued injecting cash into the repo market each night. What began as a temporary fix became a semi-permanent operation. Eventually, in 2020, the Fed went further and created a standing facility, a permanent backstop for repo funding to ensure such spikes wouldn't happen again. But by then, critics argued the central bank had quietly re-entered the role of daily market maker of last resort.
The fallout extended beyond technical debates. The spike revealed just how dependent the system had become on central bank liquidity. It also forced investors to rethink the idea of ample reserves. Clearly, what looked ample on aggregate could be scarce in practice. The illusion of abundance had cracked. For the first time in years, the financial world glimpsed how close the core of the system could come to locking up, not because of fear, but because of math. Some analysts saw the 2019 repo panic as a rehearsal for bigger crises. When the pandemic hit in 2020, similar liquidity stresses erupted, this time far worse. Treasury markets convulsed and the Fed had to flood the system again. Looking back, many realized the 2019 episode had been a warning. The plumbing had already shown its weakness. The pandemic merely exposed it on a grander scale. Fast forward to today, and the same patterns are emerging again. Government debt is higher than ever. The Treasury continues to issue record amounts of bonds. Banks are again watching their reserves decline as the Fed unwinds its balance sheet after years of stimulus. Analysts have started warning of another potential funding squeeze, a polite way of saying that the pipes could clog again at any time. The unsettling part is how familiar the setup looks. The story arc repeats. Excess liquidity builds up during easy money years, regulations and structure trap it in silos, then when the tide turns, cash can't move freely. A small calendar shock or market event acts as the match, and suddenly the system finds itself gasping for liquidity. The cycle resets. Boom, tighten, clog, rescue, repeat. For ordinary people, this might seem remote, a crisis among banks and hedge funds. But it matters because these mechanics influence every financial rate that touches your life. When short-term funding dries up, borrowing costs ripple outward. Corporate credit tightens, investment slows. Eventually, it hits jobs, housing, and savings. The repo panic was a glimpse into how quickly technical problems in the financial core can reach the real economy.
three big lessons stand out. First, it's not the total amount of liquidity that protects a system, but how it's distributed and accessed. Cash sitting in the wrong place can be as useless as no cash at all. Second, the most dangerous crises often start in the shadows, not with dramatic crashes, but with small failures in the plumbing. And third, temporary fixes rarely solve structural flaws. The Fed's interventions calmed the panic, but didn't fix the underlying rigidity that caused it. The warning is clear. We may not be asking if such an event will happen again, but when. The triggers might differ: debt ceiling fight, a large settlement day, or a sudden flight to safety, but the mechanics remain. The system's plumbing is still complex, still fragmented, still dependent on trust that liquidity will appear when needed. And trust, as history shows, is the first thing to vanish in a panic. What's striking is how few people even know this happened. While news feeds in 2019 focused on trade wars and politics, a quiet storm was passing through the heart of finance. If the Fed hadn't acted within hours, the disruption could have spread to treasury markets and beyond. The lesson isn't about panic, it's about vigilance. Crises rarely announce themselves in headlines. So the next time you hear that everything is fine because markets are calm, remember that calm often masks fragility. The 2019 repo spike was a 2-day event, but it exposed years of hidden tension. It showed that stability in modern finance isn't the absence of risk. It's the constant management of risk that never really goes away. The gears may be turning smoothly, but only because someone is always standing by with oil. If you've watched this far, stay curious, subscribe, comment, and think of this story as a reminder that the biggest financial shocks often start where no one's looking. The repo panic of 2019 wasn't just a technical hiccup, it was a glimpse into how fragile our safe systems really are. The next time the gears grind, we might not get such a gentle warning.